Welcome to session 7, Investment Decisions. This is the outline of the session: nature of investment decisions, cash flows, cost of capital, investment criteria, risk analysis, evaluation by financial institutions, strategic aspects and options. If you wish to learn more about investment decisions, you can consult my book, Projects, Planning, Analysis, Selection, Financing, Implementation and Review by McGraw-Hill. It is in 9th edition. Financial management is primarily concerned with investment and financing decisions aimed at maximizing firm value. Investment decisions are the most important decisions taken by a firm. These decisions involve substantial outlays, have considerable risk associated with them, and have a bearing on the organization for many years to come. Financing decisions arise in the context of investment decisions. In this session, we will examine various facets of investment decisions. In the following session, we will look at the financing decisions. Accounting is concerned with the past. Accounting deals with certainty. Accounting involves a review of what has happened. Finance deals with future. Finance is concerned with uncertainty. Finance is focused on decision making. Obviously, finance is more exciting and challenging. Investment decisions may be divided into two broad categories: organic investments and inorganic investments. Organic investments are investments in new plants, expansion of an existing plant, modernization of existing facilities and plants, diversification in related and unrelated areas. Inorganic investments acquire acquisitions, purchase of a unit, takeover and merger. These decisions, whether they are organic investments or inorganic investments, have certain characteristics. They involve costs which are incurred now and in near future in the hope of deriving benefits extending far into future. Costs and benefits must be measured in terms of post-tax cash flows. Conceptualizing, analyzing and evaluating investment proposals is a very time-consuming and resource-intensive exercise. Here is a schematic diagram showing how the feasibility study is done. The process starts with generation of ideas, which may be done during the strategy formulation phase. These ideas are subject to initial screening. If the initial screening suggests that an idea is prima facie promising, further analysis and investigation is undertaken. A feasibility study is planned. If the idea is prima facie not promising, it is terminated. Feasibility analysis starts with market analysis and technical analysis. The inputs of market analysis and technical analysis become the foundation for conducting financial analysis. If financial analysis suggests the project is worthwhile, economic and ecological analysis are undertaken. If these examinations suggest that the project can be undertaken and project is worthwhile, then a funding proposal is prepared. Otherwise, the project is terminated. The whole exercise involves inputs from various sources and a team of people having a variety of backgrounds and wide range of experience and different expertise. The key steps involved in investment analysis and decision are: 1. Estimate cash flows. 2. Compute the cost of capital. 3. Calculate NPV and IRR. 4. Evaluate risk. And 5. Assess strategic aspects and options. Our discussion will follow more or less this sequence. Every project involves two sides, the investment side and the financing side. Cash flows on these two sides must be separated. This is the import of the separation principle. To understand the separation principle, let us consider a very simple example. Your broker calls you and says that if you invest 100,000 rupees in a certain equity stock, you can hope to sell it after a year for 120,000 rupees. You do not have funds, so you call your banker. The banker is willing to give you a loan of 100,000 at an interest rate of 14%. So you have to repay 114,000 a year from now. we find that this project has an investment side and a financing side. On the investment side, there is an outlay of 100,000 followed by an expected inflow of 120,000. On the financing side, there is an inflow of 100,000 followed by an outflow of 114,000. There is a cost of financing which is 14%. We are not mingling financing flows with investment side. We are not deducting the financing charges from 120,000. The cost of financing is reflected in a hurdle rate of 14% that we'll apply to judge whether cash flows on the investment side represents an attractive or worthwhile investment proposition. When we look at the investment side, we find that return on investment is 20%, cost of capital on the financing side is 14%. Since 20% is higher than 14%, we say the project is worthwhile. But remember, all cash flows relating to financing side must be separated from cash flows relating to investment side. In the first part of our discussion, we will focus on cash flows relating to investment side. While estimating cash flows, bear in mind the following principles. 1. Focus on post-tax cash flows. What matters is post-tax cash flow that represents the purchasing power. This principle is very easy to understand in a personal context. Suppose you work for a company and the company says that the CTC to the company is 30 lakh. However, your take-home pay is only 20 lakhs after all deductions. What matters to you is the take-home pay of 20 lakhs, not the CTC of 30 lakh. I often say take-home pay is truly take-home pay. Once you get it, you can't go anywhere else except home. 2. Measure cash flows on an incremental basis. A project can have a complementary relationship or a competitive relationship with other projects of the firm. We have to understand those effects and measure the post-tax cash flows of the project on an incremental basis. 3. Exclude financing costs. When we are looking at cash flows on the investment side, we should not look at financing costs. Financing costs have to be considered separately as we have learned in the separation principle. 4. Treat inflation consistently. You can evaluate a project in nominal terms or you can evaluate a project in real terms. In my practical experience, I have come across several situations where incremental cash flows were not defined properly. Here are some guidelines to be borne in mind in defining incremental cash flows. 1. Consider all incidental effects. A project can have complementary relationship with the existing activities of the firm. It may augment the revenues and increase the income from existing activities. Such complementary effects should be taken into account. A project can have competitive relationship with existing activities. It may erode revenues from existing activities and the incomes derived therefrom. Such competitive effects or negative effects should also be taken into account. 2. Ignore sunk costs. Sunk costs are costs which have already been incurred in the past. They are not relevant for current decision making. For example, a firm may have spent 5 million rupees in conducting a market survey. After that, it has to decide whether it should invest in the project or not. The expenditure on market survey is a sunk cost. It is not relevant for future decision making. Bygones are bygones. 3. Include opportunity cost. A project may use certain resources already available with the firm. We have to ask what is the best alternative use of that resource. For example, a project may use a vacant land which is currently available with the firm. We have to ask what is the best alternative use of this vacant land. If it can be leased out at an annual lease rental of 10 million rupees, the project should be burdened with that lease rental because if the project is undertaken, the firm cannot lease out the piece of land. 4. Question the allocation of overhead costs. It's a common practice in organization to allocate overhead costs to various divisions on some reasonable basis. Suppose a firm has two divisions, A and B, and its organizational overheads are 30 million. A and B are of equal size, and it allocates the organizational overhead of 30 million equally to A and B. Now it is considering a new project C, which will be undertaken in a new division. This project will be more or less the same size of the two existing projects. You have to ask what happens to organization overheads when this project is undertaken. If organization overheads remain unchanged, then there should be no allocation of organizational overhead to the new project or project C, but it is not commonly done. In many organizations, 30 million is likely to be divided equally across the three divisions A, B, and C. This has to be avoided. We have to always bear in mind what happens with the project and what happens without the project in future. Let me illustrate some of the mistakes with the help of a real-life example. This example of Lockheed Company in 1979. Though it is a slightly dated example, it is vivid in my memory because I was working in the US then. Lockheed Company had spent $1 billion on a prestigious project called TriStar project, which had important applications for the US defense. After incurring $1 billion, it did not have money to continue the project further, so it approached the US government for financial help. It said, we need $1 billion of more money to complete the project. Once we do that, the annual benefits would be $180 million, and for our purpose, we can assume that these benefits would occur year after year forever. They said if we are not able to continue the developmental work, we will have to abandon the project. If we abandon, we'll realize just $200 million, even though we have spent $1 billion in the initial development. When this proposal came to the US Congress, there were two camps in the US Congress which argued very differently. Camp A said, support the project, otherwise $1 billion will go down the drain. They were affected by sunk cost thinking. Camp B said, reject the project because a 9% return on investment is rather low. They used a norm of 12%. They argued that if $2 billion were spent and the annual benefit were $180 million, then return on investment would be 9%, which was lower than the hurdle return of 12%. To my mind, both the camps were flawed in their reasoning. The correct analysis, which calls for incremental cash flows, should be as follows. If we are at this point on the decision tree, the incremental investment associated with this path is $1.2 billion. It is $1 billion plus $200 million, because if the project were abandoned, $200 million would be realized. If the project is developed further, this 200 million is foregone and an additional 1 billion is spent. So incremental investment is $1.2 billion, and incremental annual benefit would be $180 million, because if the project is abandoned, there is no annual benefit. So the difference between 180 and 0 is 180. So the project has an ROI of 15%, incremental investment $1.2 billion, annual benefit $180 million. What are the components of the cash flow stream on the investment side? There are three components: initial outlays, operating cash inflows, and terminal flows. Initial outlays are outlays on fixed assets and net working capital. Fixed assets are assets like land, building, plant and machinery. Net working capital is current assets minus non-interest bearing current liabilities such as trade payables and accruals. Operating cash inflows are defined as profit after tax plus depreciation plus other non-cash charges minus additional capital expenditure that may be required in future when the project grows in size minus additional net working capital that may be required in future when the project grows in size. Terminal flows are flows derived when the project is liquidated or terminated. Net salvage value of fixed assets plus net salvage value of net working capital represent terminal cash flows. To understand how project cash flows are estimated, let us look at an example. Here is a project which entails an outlay of 100 million right in the beginning, 80 million on fixed assets and 20 million on net working capital. The project has an economic life of 5 years. It is expected to generate an annual revenue of 120 million. The costs of the project other than depreciation and interest are expected to be 80 million for each of the 5 years. We are considering depreciation separately because it is a non-cash expense, and we will consider interest when we look at the financing side of the project. So interest is excluded from this analysis in conformity with separation principle. The depreciation charges of the project are shown here. The project involves an investment of 80 million on fixed assets. The depreciation rate applicable on these assets is 25%. The depreciation charge for the first year is 25% of 80 million, which is 20 million. At the end of the first year, the book value of the assets would be 60 million. The depreciation charge for the second year would be 25% of 60 million. For purpose of tax determination, depreciation charge is made as per the written down value method, and this the depreciation charge as per the written down value method. After deducting depreciation, profit before tax for year 1 is 20 million, profit before tax for year 2 is 25 million, so on and so forth. The tax rate applicable to the project is 30%, so the tax burden is 6 million for year 1, 7.5 million for year 2, so on and so forth. Profit after tax is 14 million for year 1, 17.5 million for year 2, so on and so forth. At the end of 5 years, the assets in the project would be liquidated. Fixed assets would fetch a net salvage value of 30 million. This is the value realized after paying taxes, if any, when the assets are sold. Net recovery of working capital would be 20 million. It is generally assumed that working capital would fetch an amount equal to original investment because working capital represents capital which renews itself all the time. It is not subject to depreciation. One set of inventories is replaced by another set of inventories. One set of receivables is replaced by another set of receivables. So the standard assumption in project analysis is that net working capital would be recovered at the original cost. Now we have information to define initial outlay, operating cash flow and terminal cash flow, the three components of cash flow stream. Initial outlay is 100 million. Operating cash flow for year 1 is 34 million. Operating cash flow is defined as profit after tax plus depreciation. Depreciation is non-cash charge, so it is added back to profit after tax. The operations of year 1 generate a post-tax cash flow of 34 million. You can look at it in a different way. 120 million are revenues. Costs other than depreciation and interest is 80 million. Tax burden is 6 million, so 120 million minus 86 million is 34 million. At the end of year 1, the project would generate a cash surplus of 34 million. Come year 2, the net cash surplus generated by the project would be profit after tax plus depreciation, which is 32.5 million. So I have the operating cash flow for the 5-year period. The terminal cash flow is the sum of the net salvage value of fixed assets and net working capital. So we have the three components of the cash flow stream. This row represents the summation of these three components: minus 100 million plus 34 million plus 32.5 million, so on and so forth. In the final year, it is 29.9 plus 50, 79.9. So the cash flow stream associated with the project is defined in this manner. In essence, we are saying that this project entails an outflow of 100 million followed by an expected inflow of 34 million at the end of year 1, 32 million at the end of year 2, so on and so forth. In the last row, I have also shown the book value of investment. This is an accounting number which may be of use in some context. Initial book value is 100 million. At the end of year 1, after a depreciation charge of 20 million, the book value is 80 million, so on and so forth. This represents the heart of financial analysis, so make sure that you understand each entry on this table. Let us look at the financing side of the project. On the financing side, 100 million is raised in this manner: equity 45 million, preference 5 million, and debt 50 million. Debt may come in the form of long-term debt or short-term debt. So the total financing required project would be 100 million, which is equal to the total outlay on fixed assets and net working capital. Remember, net working capital is current assets minus non-interest bearing current liabilities. Quite a mouthful. These are liabilities which do not carry any interest. These are liabilities like trade payables and accruals of various kinds. A number of factors have to be considered while making cash flow estimates. These are price, volume, variable cost, fixed cost, capital expenditure, working capital. A lot of inputs are required for estimating these items: competition from existing products, competition from technological advances, value to customer, labor variable cost, material variable cost, energy variable cost, marketing fixed cost, R&D and IT fixed cost, general administration fixed cost, property, plant and equipment required for the project, inventory, accounts receivable, accounts payable. Obviously, a lot of information has to be gathered from various sources. In a typical project evaluation exercise, a team is set up. The team consists of people from production, engineering, marketing, taxation, accounting, finance, management accounting, and so on. And a group of people bring to bear their understanding and judgment to develop cash flow estimates, which are used for financial analysis. Step 2, estimate the cost of capital. The cost of capital is the weighted average cost of different sources of finance used for the project. Conceptually, the cost of capital of any investment, project, business, or company is the rate of return the suppliers of capital would expect to receive if the capital were invested elsewhere in an investment of comparable risk. Hence, the cost of capital reflects expected return, and the cost of capital represents an opportunity cost. The three principal sources of capital used in a business are equity, preference capital, and debt. So weighted average cost of capital is expressed as WERE plus WPRP plus WDRD multiplied by 1 minus tax rate. WE is proportion of equity, employed in the capital structure, RE is the cost of equity, WP is the proportion of preference employed in the capital structure, RP is the cost of preference, WD is the proportion of debt employed in the capital structure, RD is the pre-tax cost of debt, and TC is the corporate tax rate. Remember, we have to compute cost of capital in post-tax terms, so pre-tax cost of debt has to be adjusted for the tax factor because debt interest is a tax deductible expense. Just the way we define post-tax cash flows on the investment side, we define post-tax cost of capital on the financing side. So the key points are we have considered only three types of capital: equity, preference, and debt. Debt includes long-term debt as well as short-term debt. Non-interest bearing liabilities such as trade creditors are not included in the calculation of weighted average cost of capital. How is the cost of equity estimated? There are several approaches for estimating cost of equity: capital asset pricing model approach, bond yield plus risk premium approach, dividend growth model approach, earnings price ratio approach. The most popular approach currently in practice is the capital asset pricing model approach. We have already discussed the capital asset pricing model in a previous session. According to the capital asset pricing model, the required rate of return on the equity of a company is equal to risk-free rate plus beta of the equity of the company multiplied by market risk premium, which is defined as expected return on the market portfolio minus risk-free rate. Here is an illustration. Risk-free rate is 7%, beta of equity is 1.2, expected return on the market portfolio is 15%. So the required rate of return on the equity of the firm is 7% plus 1.2 times 15 minus 7, which works out to 16.6%. Inputs for the CAPM. While there is disagreement among finance practitioners, the following would serve our purpose. The risk-free rate may be estimated as a yield on long-term government bonds that have a maturity of 10 years or more. The market risk premium may be estimated as the difference between the average return on the market portfolio and the average risk-free rate of return over the past 10 to 30 years. The beta of the stock may be calculated by regressing the monthly returns on the stock on the monthly returns on the market index for the past 60 months or so. While the capital asset pricing model has several limitations and flaws, it is immensely popular. There are several reasons for its popularity. 1. Beta can be estimated with short data of 3 years or 5 years. 2. Risk-free rate of return can be easily established. 3. The market risk premium based on historical data can be computed. 4. The model is theoretically elegant. 5. The distinction between unique risk and systematic risk is intuitively appealing and widely accepted. 6. There is lesser room for judgment when CAPM is employed. Bond yield plus risk premium approach. According to this approach, the cost of equity of a firm is equal to yield on long-term bonds to firm plus risk premium. Suppose the yield on the long-term bonds to firm is 9% and we add a risk premium of 4%. We get a cost of equity of 13%. This approach is intuitively appealing because people look at the yield on the long-term bonds of firm and say that equity investors will require a higher rate of return, so add some risk premium to that. The problem with the approach, however, is how should we define the risk premium? Should it be 2%, 4%, or any other number? There seems to be no objective way of determining it. Dividend growth model approach. In a previous session, we learned that if the dividend per share grows at a constant rate of G%, then the price of the share can be calculated using this formula. PO is equal to D1 divided by RE minus G, where D1 is dividend expected a year from now, RE is the required rate of return on equity, minus G, where G is the constant growth in dividend. When we use a model like this, we find that RE is equal to D1 divided by PO plus G. The first component here represents the dividend yield. The second component represents the growth in dividend that will be sustained over future. Thus, the expected return on equity shareholders, which in equilibrium is also the required rate of return, is the dividend yield plus expected growth rate. This approach is quite appealing because we can estimate the dividend yield fairly easily. If a share is currently selling for 100 rupees, we have a fair idea as to what dividend the share is likely to fetch in a year's time. If the dividend expected is 2 rupees, we say dividend yield is 2%. To that we add a growth factor. Estimating G is rather difficult, but there are ways and means of doing that, and this formula has a lot of appeal because it breaks down cost of equity into two components which people intuitively understand: dividend yield and growth rate. The growth rate dominates the cost of equity calculation. Getting a handle over the growth rate is rather difficult. Here are some ways of doing it. Analyst forecasts of growth rate. Equity analysts project growth rates for 5-10 years for many companies. So if you look at the forecast provided by analysts and average the forecast given by 3 or 4 analysts, you get a reasonable handle of the growth rate. Average annual growth rate in the preceding 5 to 10 years. You can look at the average annual growth rate in dividends of the company over the preceding 5 to 10 years and use that as a proxy for the future growth rate. Retention rate multiplied by return on equity. This is the sustainable growth rate formula that we had learned earlier. If the retention rate of a firm is 0.7 and return on equity is 12%, we say sustainable growth rate is 0.7 into 12, which is 8.4%. Earnings price ratio approach. According to earnings price ratio approach, cost of equity is E1 divided by PO, where E1 is expected EPS for the following year divided by the current market price. This approach has a lot of appeal because people say, let us look at what earnings are likely to be generated in a year and what is the current market price. If the market price is 100 rupees and EPS is likely to be 10 rupees, then they say cost of equity is 10%. This approach provides an accurate measure only in two cases: when the EPS is constant and the dividend payout ratio is 100%, when retained earnings earn a rate of return equal to the cost of equity. These assumptions are rarely, if ever, fulfilled in practice, so one has to be cautious in using this approach. Let us look at the computation of the cost of equity for the project of Naveen Enterprises. The project entailed an outlay of 100 million and the financing mix used for the project is shown here: 45 million of equity, 5 million of preference, 50 million of debt. The costs associated with these sources of finance may be assumed to be 20% for equity, 15% for preference, and 10.5% for debt on a post-tax basis. The pre-tax cost of debt is 15% since the tax rate is 30%. The post-tax cost of debt is 10.5%. These are post-tax costs associated with these three sources of finance. These are the proportions or weights in which these sources of finance are used. So we calculate the weighted average cost of capital in this manner. Cost is 20%, weight associated with the source of finance is 0.45, the product of 20% and 0.45 is 9%. Cost is 15%, weight is 0.05, the product of the two is 0.75. cost is 10.5%, weight is 0.5, the product 2 is 5.25. Add all these numbers and you get 15% as the post-tax weighted average cost of capital applicable to that project. Here is a simple illustrative problem. Rao Corporation is a target capital structure, 60% equity and 40% debt. Its cost of equity is 18% and its pre-tax cost of debt is 13%. If the relevant tax rate is 35%, what is Rao Corporation's weighted average cost of capital? The weighted average cost of capital for Rao Corporation is 0.4, which is the weight applicable to debt multiplied by pre-tax cost of debt multiplied by 1 minus tax rate plus 0.6, which is the weight applicable to equity multiplied by cost of equity, which is 18%. So the weighted average cost of capital works out to 14.18%. Here is another problem. Unix Limited's equity beta is 1.2, the market risk premium is 7%, and the risk-free rate is 10%. Unix has a debt-equity ratio of 2 to 3. Its pre-tax cost of debt is 14%. If the tax rate is 35%, what is the weighted average cost of capital for Unix Limited? The weighted average cost of capital for Unix Limited may be calculated as follows. Cost of equity using capital asset pricing model is risk-free rate of return 10% plus beta of 1.2 multiplied by market risk premium of 7%. So cost of equity is 18.4%. Pre-tax cost of debt is 14%. After-tax cost of debt is 14% multiplied by 1 minus tax rate. This works out to 9.1%. Debt-equity ratio is 2 to 3, which means the proportion of debt in the capital structure is 2 by 5. The proportion of equity in the capital structure is 3 by 5. Hence, the weighted average cost of capital is 2 by 5 multiplied by 9.1% plus 3 by 5 multiplied by 18.4%, and this works out to 14.68%. These are currently regarded as the best practices in estimating the cost of capital. DCF is the dominant investment evaluation technique. Weighted average cost of capital is the dominant discount rate used in DCF analysis. Weights are based on market, not book value of debt and equity. The after-tax cost of debt is predominantly based on marginal pre-tax cost and marginal or statutory tax rate. The capital asset pricing model is the dominant method for estimating the cost of equity. How do companies estimate the cost of equity? According to a survey done by Dr. Manoj Anand, the importance assigned to various approaches is shown here. Capital asset pricing model is considered by 54.3% of the companies as important or very important. Gordon's dividend discount model is considered by 52.2% of the companies as very important or important, so on and so forth. What factors affect the weighted average cost of capital? There are two sets of factors, factors outside a firm's control and factors within a firm's control. Factors outside a firm's control are the level of interest rates, market risk premium, tax rates. Factors within a firm's control are investment policy of the firm, capital structure policy of the firm, dividend policy of the firm. How do financial institutions calculate cost of capital? In India, financial institutions calculate cost of capital as post-tax weighted average cost of the mix of funds employed to the project. The cost of different sources of funds are taken as follows. Equity share capital 15%, cash accruals and retained earnings 15%, preference share capital, preference dividend rate, subsidy or incentive loans 0 cost, debt post-tax rate of interest. Debt includes long-term loans, non-convertible debentures, deferred credits, bank borrowings for working capital, unsecured loans from public convertible debenture, convertible portion at 15%, non-convertible portion at post-tax interest rate. Here is a numerical illustration. The means of financing of a project are listed here. The total amount of financing is 2600 million. Equity and cash accruals account for 900 million. Cost of equity and cash accruals is 15%. So 900 million multiplied by 15% gives 135 million. Preference capital accounts for 100 million. Preference dividend rate is 10%, so 10% multiplied by 100 million is 10 million. Rupee term loans are 800 million. They carry an interest rate of 14%. The post-tax cost of rupee term loans is 10.5%. The tax rate has been assumed to be 25%, so 14% multiplied by 1 minus 0.25 gives 10.5%. 800 is multiplied by 10.5% to get 84 million. 400 million of non-convertible debentures carry an interest rate of 12%. The post-tax cost of funds is 9%. 9% multiplied by 400 is 36 million. Convertible portion of convertible debentures are 100 million. Cost of funds is 15%. 100 million multiplied by 15% is 15 million. Non-convertible portion of convertible debentures is 100 million. The interest cost is 10%, so the post-tax cost is 7.5%. 100 million multiplied by 7.5% gives 7.5 million. Bank borrowing is 200 million at an interest cost of 15%. In post-tax terms, it is 11.25%. So 200 million multiplied by 11.25% gives 22.5 million. If we add the total cost in post-tax terms, the figure is 310 million. Total financing is 2,600 million. So the average cost of capital post-tax term is 310 divided by 2,600. It works out to 11.92%. So we find the procedure used by financial institutions is in conformity with the procedure that we have discussed here. I have come across several misconceptions characterizing the calculation and application of cost of capital in practice. Here are the more common ones. The cost of equity is equal to the dividend rate or return on equity. If the rate of dividend is 12%, some say cost of equity is 12%, or if the return on equity of the firm for the previous year was 15%, some say cost of equity is 15%. Dividend rate or return on equity are historical accounting numbers. They have no relationship whatsoever with cost of equity. Cost of equity represents the expectation of investors at the current point of time given the opportunities available to them elsewhere. It is an opportunity cost measure. Retained earnings are either cost free or cost significantly less than the external equity. Retained earnings are available within the firms, so there is a tendency to impute a lower cost to retained earnings. This is again a fallacious way of looking at things. Retained earnings can technically be distributed to shareholders who have opportunities elsewhere in the capital market. So the cost of retained earnings is almost the same as the cost of external equity. Share premium has no cost. Suppose a firm issues a share which has a par value of 10 rupees and it charges a premium of 90 rupees. The share is issued at 100 rupees. Some argue that as far as the company is concerned, it will have to pay dividend only on the par value of 10 rupees and not the share premium of 90 rupees. So they say share premium has no cost associated with it. This is a fallacious argument. As far as the equity investor is concerned, the equity investor is paying 100 rupees to the company, and the equity investor expects a certain return on the entire investment of 100 rupees. The equity investor is not bothered how the company divides that 100 rupees between par value and share premium. Depreciation is no cost. Some argue that depreciation generated funds are internally available in the firm, so they have no cost attached to them. This argument is fallacious because depreciation generated funds can be returned back to investors, and hence the cost of depreciation generated funds is the weighted average cost of capital of the firm. Please remember the opportunity cost principle. Cost of capital can be defined in terms of an accounting-based measure. Cost of capital is an economic concept and not an accounting concept, so it can't be defined in terms of an accounting-based measure. A company must apply the same cost of capital to all projects. There is an argument that a company raises funds from several sources and these funds are deployed for various projects, so all projects should be assigned the same cost of capital. This argument is not valid because the cost of capital for a project depends on the riskiness of the project and the debt capacity of the projects. Projects vary widely in terms of their riskiness and debt capacities. Every project has a cost associated with it depending on its riskiness and debt capacity. One can argue that the weighted average cost of capital of the firm is derived from the cost of individual projects undertaken by the firm and not vice versa. If a project is financed heavily by debt, its cost of capital is low. Companies go to capital market infrequently and companies raise money in a somewhat lumpy fashion. If a company has a target debt equity ratio of 1 to 1, it doesn't mean that the company will raise money from debt and equity in equal proportions every time it goes to the capital market. It may raise debt when conditions for raising debt are more favorable. It may raise equity when conditions for raising equity are more favorable. In the long run, it will try to have a debt equity ratio of 1 to 1, but in the short run, there are departures depending on opportunities in the capital market. So, when a project is undertaken, it is very likely the company is raising debt at that point of time. This does not mean that the project has a lower cost of capital associated with it. It simply means that the firm is relying more on debt at that point of time because conditions for raising debt are more favorable. Eventually, the firm will rely on equity and restore the debt equity ratio of the firm. Having discussed cash flows and cost of capital, let us now turn our attention to investment criteria. A wide range of investment criteria are used for evaluating investment opportunities. These criteria may be divided in two broad categories: non-DCF criteria and DCF criteria. Non-DCF or non-discounted cash flow criteria are criteria which do not take into account time value of money. The two most commonly used non-DCF criteria are payback period and accounting rate of return. DCF or discounted cash flow criteria take into account the time value of money. The most important DCF criteria are net present value or NPV, internal rate of return or IRR, profitability index or PI. Let us look at these criteria in some detail. Payback period is perhaps the simplest of all the criteria. The payback period is the length of time required to recover the initial outlay on the project. We have here the cash flows of Naveen Enterprises capital project. Year 0 minus 100 million, year 1 34 million, year 2 32.5 million, so on and so forth. we ask how much time will it take for Naveen Enterprises to recover 100 million of outflow. One can look at cumulative cash flow column minus 100. After recovering 34 million, it is minus 66. After recovering 32.5 million, it is minus 33.5 million. After recovering 31.37, it is minus 2.13 million. It means a little over 3 years are required to recover the original investment of 100 million. So that represents the payback period. The advantages of the payback period are it is simple, it is a rough and ready method for dealing with risk because risk tends to increase with time. It emphasizes earlier cash inflow. The disadvantages are it fails to consider the time value of money, which is a very foundational principle of finance. It ignores cash flows beyond the payback period. Average rate of return or accounting rate of return is defined variously. Here is a popular definition. Average profit after tax over the life of the project divided by average book value of investment reckoned at the beginning of each year. Here is the information for Naveen Enterprises capital project. Book value of investment at the beginning of year 1, 100 million. Book value of investment at the beginning of year 2, 80 million, so on and so forth. Profit after tax for the 5 years is shown in this column. Average profit after tax is the average of these 5 numbers, and average book value of investment at the beginning of each year is the average of these 5 numbers. Dividing this by this, we find that the average rate of return or accounting rate of return is 28.31%. Average rate of return is fairly commonly used. It has certain advantages. It is simple. It is based on accounting information that is familiar to businessmen. It considers benefits over the entire life of the project. It can be calculated with limited data. Even if you don't have projections for the entire life of the project, you can calculate the average rate of return based on information for 2 to 3 years. The disadvantages of accounting rate of return or average rate of return are it is based on accounting profit, not cash flow. It does not take into account the time value of money. Net present value or NPV is the most important criterion in finance. NPV is defined as present value of benefits minus present value of costs. NPV is expressed in this equation. NPV is equal to the present value of all the cash flows associated with the project from 0 to n. The initial cash flows are likely to be negative and subsequent cash flows are likely to be positive. These cash flows are discounted at the weighted average cost of capital of the firm. The net present value calculation for the project of Naveen Enterprises is shown here. The cash flows of the 5-year period are shown in this column. The discount factor applicable to these cash flows is shown in this column. This discount factor is based on the assumption that the weighted average cost of capital is 15%. The present value of each of these cash flows is calculated in this column by applying the relevant discount factor. For example, as far as the first cash flow is concerned, the present value is also minus 100 million. The second cash flow is 34.00. The discount factor is 0.870. So its present value is 29.58. The third cash flow is 32.50 and the discount factor applicable to it is 0.756. So its present value is 24.57. Likewise, we have the present values of other cash flows. When we add all these numbers, we find that the net present value of the project is 31.96 million. It means that this project generates a surplus of 31.96 million in present value terms. This has a very important economic interpretation. It means that the project augments the wealth or value of the firm by 31.96 million. We said earlier that the primary objective of financial management is to maximize the value of the firm, and projects which generate positive NPV augment the value of the firm. This particular project is expected to augment the value of the firm by 31.96 million. The advantages of net present value criterion are: it reflects the time value of money, it considers the cash flow in its entirety, it squares with the objective of wealth maximization. Its only disadvantage is that it is an absolute measure and not a relative measure. Some people find it difficult to comprehend an absolute measure. They are more comfortable with a relative measure like profitability index or internal rate of return. Internal rate of return, or IRR, is perhaps the most popular investment criterion. The IRR of a project is a discount rate that makes its NPV equal to 0. If we plot NPV against the discount rate, we find that NPV declines as the discount rate increases. This applies to most of the projects that we encounter in real life. NPV is the highest when the discount rate is 0% and NPV declines in this manner. The discount rate at which NPV becomes 0 is called the internal rate of return. It is a point of intersection in this graph. The equation for IRR is given here. In this equation on the right hand side we have the expression for NPV. We set NPV equal to 0. We solve this equation for R, which is the discount rate. IRR cannot be determined analytically. We have to try a few discount rates till we find the discount rate that makes the NPV equal to 0. Let us use an iterative procedure for calculating the IRR for the project of Naveen Enterprises. The cash flows of the project over the 5-year period are shown here. The discount rate of 20% is tried initially. At this discount rate, the discount factors are as shown in this column. The present values are as shown in this column. If we add all of these numbers, we find that the NPV is 15.88 million. Our objective is to drive down NPV to 0. Since NPV is positive, we try a higher discount rate. In the table given in the book, the next discount rate is 24%. When we apply 24% discount rate, the present values of various cash flows are as shown in this column. The sum adds to 5.13 million. The NPV is still positive, so we try the next higher discount rate given in the table, which is 28%. At 28%, the NPV turns negative. We surmise that the true discount rate lies somewhere between 24% and 28%. Maybe it is around 26%. It is instructive to compare NPV and IRR. When we calculate NPV, the discount rate is given and the NPV to begin with is an unknown quantity. In the case of IRR, we set NPV as equal to 0, so NPV is given and IRR to begin with is an unknown quantity. A practical problem with NPV is that it is an absolute magnitude. Managers often find a relative number easy to understand. Herein lies the appeal of benefit cost ratio, also called as profitability index. Benefit cost ratio is defined as present value of benefits divided by investments. There is another measure called net benefit cost ratio, which is defined as present value of benefits minus investment divided by investment. So net benefit cost ratio is simply benefit cost ratio minus 1. To illustrate the calculation of these measures, let us consider a project which has the following benefits associated with it. The initial investment is 100,000. The cost of capital is 12%. The benefit cost ratio measures for this project are calculated here. Benefit cost ratio is present value of benefits divided by initial investments. It is 1.145. Net benefit cost ratio is 0.145. According to this criterion, a project is worthwhile if the benefit cost ratio exceeds 1 or net benefit cost ratio exceeds 0. While we calculated NPV and IRR by hand to understand the concepts, in practice we use Excel spreadsheets. Here is a spreadsheet for calculating NPV, and here is a spreadsheet for calculating IRR. So far we assume that cash flows occur periodically every year or every half year or every quarter and so on. In finance, many cash flows, however, do not occur periodically. In such cases, the standard functions of net present value and internal rate of return have to be modified to reflect the actual dates when the cash flows occur. These functions are called extended NPV or XNPV and extended IRR or XIRR. XNPV is defined by this equation, where C1 is the ith cash flow, DI is the ith cash flow date, D1 is the 0th date, R is the discount rate. XIRR or extended internal rate of return is the interest rate corresponding to XNPV equal to 0. To calculate XNPV and XIRR, use the Microsoft Excel functions XNPV and XIRR. The decision rules associated with various criteria are fairly straightforward. NPV, accept the project if NPV is greater than 0, reject the project if NPV is less than 0. IRR, accept a project if IRR is greater than weighted average cost of capital, reject the project if IRR is less than weighted average cost of capital. Benefit cost ratio, accept a project if the benefit cost ratio is greater than 1, reject a project if the benefit cost ratio is less than 1. Payback period, accept a project if the payback period is less than a specified number, reject the project if the payback period is more than a specified number. On paper, most projects have a positive NPV. We tend to suffer from planning fallacy, which makes us overestimate benefits and underestimate costs. So we have to go beyond the numbers and ask what entry barriers can possibly result in positive NPV. The most common entry barriers that can lead to positive NPV are economies of scale, product differentiation, cost advantage, marketing reach, technological edge, and governmental policy. We have to examine these factors to determine whether the project enjoys certain benefits which can lead to positive NPV. So far we looked at single point estimates of various factors like investment outlay, quantity, price, variable cost, project life, and so on. In real life, all these factors are subject to variation, so some kind of risk analysis needs to be done. The various approaches or techniques to risk analysis are listed here: payback period, break-even point, sensitivity analysis, scenario analysis, Monte Carlo simulation, and decision tree analysis. Payback period is the time required to recoup the initial investment. The shorter the payback period, other things being equal, the less risky the project. Break-even point refers to the quantity that should be manufactured and sold in order to break even. Sensitivity analysis explores the impact of underlying variation in factors on NPV or IRR. In sensitivity analysis, we look at variation in one factor at a time. Scenario analysis is an extension of sensitivity analysis wherein we look at variations of two or more factors simultaneously. Monte Carlo simulation is a further extension of scenario analysis where we look at probability distributions of underlying factors and the impact of variations in these underlying factors on the probability distribution of NPV or IRR. Decision tree analysis is used in situations where sequential decision making is involved. Our focus will be mainly on elementary tools like payback period, break-even point, and sensitivity analysis. These tools, which are somewhat advanced, are covered in greater detail in my book on projects for those who want to understand these techniques. To understand break-even analysis and sensitivity analysis, let us look at an example. The cash flow forecast for Apex Flour Mills project is given in this table. Initial investment outlay 20 million, economic life of the project 10 years, annual sales 18 million, sales will remain constant year after year, variable cost two-thirds of sales, which means 12 million per year, fixed cost 1 million per year. Depreciation would be charged using the straight line method. It is assumed that the salvage value would be nil after 10 years, so the annual depreciation charge would be 2 million. It is also, for the sake of simplicity, assumed that this is a charge applicable for tax purposes as well. Pre-tax profit 3 million. Taxes, given a tax rate of 33.3%, 1 million. Profit after tax 2 million. Cash flow from operation is 4 million. Profit after tax plus depreciation. The net cash flow stream for the project is an outlay of 20 million at the end of year 0, followed by an inflow of 4 million at the end of each year for 10 years. The net present value of the project is minus 20 million plus present value of an annuity of 4 million for 10 years. So 4 million is multiplied by a present value annuity factor where R is 12% and N is 10 years. The discount rate is assumed to be 12%. PVA R equal to 12%, N equal to 10 is 5.650. So NPV is minus 20 million plus 4 million multiplied by 5.65. This works out to 2.6 million. How sensitive is NPV to changes in the value of key variables? The key variables are investment outlay, sales, variable cost as a percentage of sales, and fixed cost. The expected values of the key variables are shown here. The ranges of values for the key variables are shown here. Investment outlay, pessimistic estimate 24 million, optimistic estimate 18 million. Sales, pessimistic estimate 15 million, optimistic estimate 21 million. Variable cost as a percentage of sales, pessimistic estimate 70%, optimistic estimate 65%. Fixed cost, pessimistic estimate 1.3 million, optimistic estimate 0.8 million. Now we look at variations in one factor at a time and the impact of that variation on NPV. To do that analysis, we hold the other variables at their normal or expected levels. For example, if we want to know what will be the impact of an adverse variation in investment outlay is put at 24 million. All other variables are held at their normal level. Of course, if the investment outlay is 24 million, annual depreciation charge would be 2.4 million and the tax benefit correspondingly will be higher. Taking all that into account, the NPV is calculated and the NPV works out to minus 0.65 million. If the investment outlay is only 18 million, then NPV works out to 4.22 million. We do a similar analysis for other variables, sales, variable cost as a percentage of sales, and fixed cost, and we find a table like this which shows sensitivity of NPV to variations in underlying factors. We look at one factor at a time. Of course, when all the factors are at their expected values, NPV would be 2.6 million as we had calculated earlier. Break-even analysis. There are two notions of break-even analysis: accounting break-even analysis and financial break-even analysis. What is accounting break-even point? Accounting break-even point is the level of operation at which the firm neither makes profit nor incurs losses from an accounting point of view. Accounting break-even point is calculated as fixed cost plus depreciation. These are the uh, costs to be covered from the contribution generated from sales. The fixed costs annually are 1 million. Depreciation is again a fixed cost, so it is 2 million. 3 million is the total fixed cost. Contribution margin ratio is 0.333. Remember, variable cost as a percentage of sales is 66.7%. So contribution margin ratio is 33.3% or 0.333. So 3 million divided by 0.333 gives us 9 million. This means that if the annual sales are rupees 9 million, the firm will break even in an accounting sense. You can see why it is so. If the sales are 9 million, contribution would be one third of sales, that is 3 million, and 3 million would suffice to cover fixed cost plus depreciation, and the firm will break even in an accounting sense. After assessing risk, an adjustment for risk may be made. Risk is adjusted in terms of the discount rate, the cash flows, or the payback period. A survey of the relative importance of various methods of project risk analysis revealed the following. Sensitivity analysis is the most important method in practice, followed by scenario analysis, risk-adjusted discount rate, decision tree analysis, and Monte Carlo simulation. Of course, this survey was done long back. My guess is that the importance of decision tree analysis and Monte Carlo simulation has increased over a period of time. Managers are not content with analyzing and assessing risk. They want to manage and mitigate risk. These are some of the ways in which companies manage risk. Fixed and variable costs. Companies try to increase the proportion of variable costs and decrease the proportion of fixed costs. This is what Infosys precisely did in 2008-2009. Pricing strategy. Publishers start with a hardbound edition which is priced higher for the premium segment to the market. Then they bring a lower cost version for the mass segment to the market. Sequential investment. Companies often sequence the investment they make. Instead of making the entire investment upfront, they make investment in different stages. Improving information. A lot of additional information is gathered when the project is perceived to be risky, so that the company is well informed about the dangers that lie ahead in the project. Financial leverage. If the degree of operating leverage the project is high, financial leverage is kept low so that overall leverage is within manageable limits. Long-term arrangements. Companies make long-term arrangements with their suppliers in order to eliminate uncertainty about price at which they buy their inputs. Similarly, they may make long-term arrangements with their customers if they want to avoid uncertainty relating to the selling price of their outputs. Strategic alliance. When a project entails substantial investment and risk, companies explore the possibility of finding strategic partners who are willing to share investment cost, risk and return. Derivatives. Financial risks have increased considerably in the last few decades. In response, companies are now using financial derivatives such as forwards, futures, swaps, and options to manage and mitigate these risks. So far, we looked at the financial aspects of project. Now we look briefly at strategic aspects and options. Firms which are engaged in multiple businesses do some kind of strategic analysis to determine their resource allocation policy. Here is a matrix which has been used by General Electric for managing its portfolio of businesses. In this matrix, there are two dimensions: business strength, strong, average, weak, industry attractiveness, high, medium, low. If the project is located in industry which has great attractiveness and the firm has a strong competitive position vis-a-vis rivals, the firm is well advised to invest heavily in that business. At the other end of the spectrum, if the business is located in an industry which is not very attractive and the firm has a weak competitive position, the business is a candidate for divestment. Along the diagonal, the firm would make sufficient investment to hold its position. Matrices of this kind are widely used in business firms to guide their resource allocation strategy. There are several important options found in capital projects, and these options are valuable. They may be classified as follows. Investment timing option: the firm can defer making its investment to an appropriate point of time. Expansion option: if the project is doing well, the firm may expand its capacity. Shutdown option: if the project is not doing well, it may be temporarily shut down. Abandonment option: if the project is not doing well and it is not likely to do well in the foreseeable future because its economic viability has been jeopardized, it may be completely abandoned. Flexibility option can be incorporated in inputs and outputs. Input flexibility means that the project is designed in such a way that it can use different inputs. Output flexibility means the project is designed in such a way that it can produce different outputs. Reliance Industries Limited, when it was designing the Jamnagar refinery, incorporated a lot of flexibility with respect to inputs as well as outputs. As a result, the project has become very viable and resilient in the wake of adverse developments. The value of real options depends on three factors: uncertainty, learning, and flexibility. If there is greater uncertainty in the environment, the value of real options tends to be higher. If there are more opportunities to learn, the value of real options is higher. If there is greater managerial flexibility to respond to uncertain developments, the value of real options is higher. Indian companies have been investing substantial sums of money in foreign projects. How should one evaluate an overseas investment proposal? India Pharma is considering a project to build a plant in the US. The project will entail an initial outlay of $100 million and is expected to generate the following cash flows over its 4-year life. $30 million at the end of year 1, $40 million at the end of year 2, $50 million at the end of year 3, and $60 million at the end of year 4. Let us assume that the current spot rate is rupees 70 per US dollar and the risk-free rate is 8% in India and 3% in the US. These are rates observed in the financial markets. India Pharma's required rupee rate of return on a project of this kind is 15%. Should India Pharma undertake this project? The answer to this, of course, depends on the NPV of the project. How is the NPV of a project like this to be calculated? There are two ways of analyzing a foreign investment proposal: home currency approach and foreign currency approach. If home currency approach is followed, two steps are involved. Convert all the dollar cash flows into rupees using forecasted exchange rates. Calculate the NPV in rupees using the rupee discount rate. If the foreign currency approach is followed, two steps are involved. Calculate the NPV in dollars, use the dollar discount rate, convert the dollar NPV into rupees using the spot exchange rate. The two approaches to international capital budgeting yield the same result. Before we show why the two yield the same result, we need to understand relative purchasing power parity. According to relative purchasing power parity theorem, the differences in rates of inflation between two currencies will be offset by a change in the exchange rate. For example, if the expected inflation rate is 6% in India and 2% in the US, then the Indian rupee will depreciate relative to the US dollar at a rate of approximately 4% per year. This is the relationship. Here, S1 expected is the expected spot rate a year from now, SO is the current spot rate, IH is the expected inflation rate in home currency, IF is the expected inflation rate in foreign currency. Example, the current spot rate for the US dollar is rupees 70. The expected inflation rate is 6% in India and 2% in the US. What is the expected spot rate of dollar a year hence? Expected spot rate of dollar can be obtained by applying this formula. In this formula, SO is 70, 1 plus H is 1 plus 0.06, 1 plus F is 1 plus 0.02. Solving this for S1 expected, we find that S1 expected is 72.75, which means if the current spot rate is 70 rupees and rupee depreciates vis-a-vis dollar at a rate of 4% per year, expected spot rate a year from now would be 72.75. Home currency approach. To apply the home currency approach, we have to come up with the forecasted exchange rates based on the parity relationships discussed earlier. The expected spot exchange rate at time t is given by this formula, where STE is the expected spot exchange rate at time t, SO is the current spot exchange rate, RH is the nominal risk-free interest rate in home currency, and RF is the nominal risk-free interest rate in foreign currency. In our example, SO is rupees 70, RH is 8%, and RF is 3%. Hence, the forecasted spot exchange rates are as follows. Year 1, 70 multiplied by 1.08 divided by 1.03, 73.40. Year 2, 70 multiplied by 1.08 divided by 1.03 raised to the power 2, 76.96, so on and so forth. Using these forecasted spot exchange rates along with the current spot rate of rupees 70, we can convert the dollar cash flows into rupees as follows. Year 0, cash outflow in dollars 100 million, exchange rate rupees 70, cash flow in rupees minus 7,000 million. Year 1, cash inflow in dollars 30 million, expected exchange rate 73.40, cash inflow in rupees 2202 million, so on and so forth. Given a rupee discount rate of 15%, the NPV in rupees is expressed in this manner: minus 7,000 plus 2202 divided by 1.15, so on and so forth. So the NPV works out to rupees 2798 million. To apply the foreign currency approach, we have to come up with a risk-adjusted dollar discount rate corresponding to the risk-adjusted rupee discount rate of 15%. To do this, we have to first find the risk premium implicit in 15%. 1 plus risk-free rupee rate multiplied by 1 plus risk premium is equal to 1 plus risk-adjusted rupee rate. 1 plus 0.08 multiplied by 1 plus risk premium is 1 plus 0.15. So 1 plus risk premium is 1.15 divided by 1.08, which is 1.0648. Applying the above risk premium to the risk-free dollar rate of 3%, we find that the risk-adjusted dollar rate is 1 plus risk-adjusted dollar rate is equal to 1.03 multiplied by 1.0648, which is 1.0967. So the dollar NPV would be minus 100 plus 30 divided by 1.0967, so on and so forth. The dollar NPV works out to $39.98 million. Since the spot exchange rate is rupees 70 per dollar, the rupee NPV would be dollar NPV multiplied by spot exchange rate of rupees 70, which is rupees 2798 million. This was the same figure that we obtained under the earlier approach. I participated in major investment decisions in several organizations. The key issues that arise in such decisions are investment story, risk, DCF value, financing, impact on EPS and options. Investment story, a question that is often asked is what is the potential, what are the competitive advantages of the firm, how can the firm benefit from its competitive advantage and exploit the potential. Risk, all major investment decisions are characterized by considerable risk. How do we address these risks? How do we ensure that overall risk exposure of the firm is manageable? DCF value, almost invariably net present value, internal rate of return, benefit cost ratio, and other indicators are calculated. A project is viewed from different angles. Financing, since major investment decisions sometimes involve substantial debt, a question that is often asked is, are we in a position to service this debt even in trying situations? Impact on EPS. Interestingly, finance theory argues that EPS is irrelevant, but in practice, EPS is a very important consideration for most managements. Perhaps they're concerned about how the EPS of the firm would behave in the short run after the project is undertaken. EPS, despite any underlying theory supporting it, seems to preoccupy the attention of managements. They regard it as a major indicator of corporate performance. Options, major investment decisions have valuable options embedded in them, and these options are evaluated even though qualitatively. Here is a glimpse into practice as Dick Granis, treasurer of Qualcomm, said Qualcomm evaluates new projects such as new products, equipment technologies, R&D, acquisitions and strategic investments by using traditional financial measurements including DCF models, IRR levels, peak funding requirements and time needed to reach cumulative positive cash flows and the short-term impact of the investment on our reported earnings. For strategic investments, we consider the possible value of financial, competitive, technology and/or market value enhancements to our core business, even if those benefits cannot be quantified. Overall, we make capital budgeting decisions based on a combination of objective analysis and our own business judgment. A lot of capital has been misallocated by corporate India investing in mega projects on account of overconfidence, excessive diversification under the influence of herd mentality, as we saw in the case of power projects and infrastructure projects. Effect heuristic, a conspicuous example is Kingfisher Airlines throwing good money after bad money. A conspicuous example is Tata Teleservices, suboptimal investment in intangible assets such as R&D, marketing, data analytics, human development because of Tangimania. 5 principles of capital allocation. 1. Zero-based capital allocation. Capital in most companies is allocated on an incremental basis. This leads to capital inefficiency. A zero-based approach is a proper approach. It determines the right amount of capital required to support a strategy which creates most wealth. A McKinsey research has shown that many companies allocate capital on incremental basis and do not follow zero-based approach. That leads to capital misallocation. 2. Fund strategies, not projects. Capital allocation is concerned with assessing and improving strategies and determining the projects that support the strategies rather than approving projects in isolation. The CEO and the board must evaluate alternative strategies and consider financial prospects of each. 3. No capital rationing. Many companies limit investments to internally generated funds because these funds are considered scarce but free. Replace this scarce but free mindset with plentiful but costly mindset. No worthwhile project should languish for want of funds. As long as a project earns a rate of return which is commensurate with its cost of capital, it should be provided funds, either from internal generated funds or from externally obtained funds. 4. Zero tolerance for bad growth. Failed investments are no sin. In fact, they're essential to the process of value creation. What is sin, however, is to remain committed to a bad strategy that drains human and financial resources. 5. Know the value of assets and act accordingly. Capital allocation is similar to portfolio management. A good portfolio manager has a good sense of how value of a security compares with price. Likewise, an intelligent capital allocator knows the difference between value and price of an asset. As Buffett said, I am a better investor because I am a manager, and I am a better manager because I am an investor. Detailed project report. A detailed project report is a business information document prepared in connection with a proposed project. It seeks to provide information for obtaining regulatory clearances and raising capital, primarily long-term debt capital. While most lenders do not prescribe a specific format for preparing a DPR, they do specify the kind of information a DPR should provide. Typically, a DPR should consist of the following: business and management section, technical and marketing section, financial section, and annexures. The key financial indicators considered by lenders are profitability indicators, gross profit margin, net profit margin, earnings per share, cash earnings per share, return on capital employed, return on net worth, financial indicators, debt equity ratio, net worth, book value per share, total tangible net worth to outside liabilities, current ratio, and interest cover. Viability indicators, debt service coverage ratio, internal rate of return, weighted average cost of capital, break-even point. We have discussed these indicators in some session or the other already. We have covered a vast terrain. Let me emphasize 7 commandments of investment decisions. 1. Forecast post-tax incremental cash flows. What matters in finance is post-tax incremental cash flow. Everything else is chimera. 2. Use at least 2 investment criteria. At a minimum, use a DCF criterion along with a non-DCF criterion. Projects are multidimensional, so they need to be looked at from various perspectives. 3. Do sensitivity analysis. All projects are characterized by risk and uncertainty. At a minimum, sensitivity analysis and scenario analysis may be done. In addition, if projects are complex, decision tree analysis and simulation analysis should also be included in project evaluation. 4. Measure cost of capital as opportunity cost. All capital has an opportunity cost associated with it. So measure cost of capital as opportunity cost. 5. Assess the strategic aspects of a project. Projects have quantifiable benefits and non-quantifiable benefits. One must look at qualitative and quantitative aspects along with strategic considerations. 6. Avoid reverse financial engineering. When the CEO is enamored of a project, it is very likely that his trusted lieutenants will produce a report which shows the project in a favorable financial light because they can tweak some of the assumptions to produce the desired financial outcome. This is reverse financial engineering. To the extent possible, it should be mitigated and avoided. 7. Pray God that things work out well. All major investment decisions are eventually acts of faith. After a lot of analysis, there is some ambiguity which is unresolved. Someone must decide for the project or against the project. It is usually a leap of faith. I am reminded of a very interesting conversation that Dr. Niels Bohr had with a science reporter. When Dr. Niels Bohr got Nobel Prize in Physics, a science reporter went to interview him at his residence and he found a horseshoe hanging in front of Dr. Bohr's residence. He asked Dr. Bohr how could he explain this superstitious omen in front of his door as he was supposed to epitomize scientific rationality. Dr. Bohr smiled at him and then pointed toward the horseshoe and said, I am told this brings good luck to the inhabitant of the house. irrespective of whether he believes in it or not. Eventually, we rely on some faith when important decisions are taken. There seems to be a fundamental paradox in human behavior. The more unpredictable the world is, the more we rely upon forecasts and predictions. There is an enchantment with future oriented techniques. It is a manifestation of superstitious behavior. We rely on such techniques because they serve important psychological functions. They relieve anxiety, they give us a sense of control, and they encourage necessary action. Faith is not the monopoly of religion, as neuroscientist David Linden says. At some level, all of us are hardwired, or at least strongly predisposed, to believe things we cannot prove. The essential act of faith is central to human function. It is an important initial step in making sense of the world. A closing comment. Major resource allocation decisions are never easy. How do you make good decisions in a high risk, technically complex business when the information you need to make those decisions comes largely from the project champions who are competing against one another for resources? A critical company process can become politicized when strong-willed, charismatic project leaders beat out their less competitive colleagues for resources. Thank you.